Should the reports like Hindenburg affect you as value investor?
Just read the Hindenburg report itself. Will basically do. And for example, I read all the Hindenburg report on Adani, and it was all factual data. Sure. So first of all, let me make this one point very clear. No moat is truly permanent or durable in today's world. Who would have thought that Google, the giant of search, the epitome of search, can get disrupted by an app called ChatGPT?
Thank you so much for accepting the invite, sir, and ready to share your wisdom with the student community of the Valuation School. So thank you so much. Yes, sir. Sir, we'll keep the mode of languages. It's like English. We'll just mix the English and Hindi, right? So without so like most of you all, most of the students over here already know you, right? They inspire you a lot. They take that inspiration from you. Almost all of my students have your book, The Joys of Compounding. They're reading it diligently, right? That is like part of our curriculum, that every student has to read that book. So I have just divided the entire conversation into three parts, right, to make it more structured. First is related to the past, current, and the second is the present, and company specific questions, not specific to the company, but research oriented questions. And third, last few questions, which is related to students, right? So just to start with, so what is your biggest investing mistake till date, and आपने क्या learning लिया उससे?
See, and investing is a probabilistic activity, which means that almost half of all our investing decisions over a full lifetime will inevitably go wrong. But what is very, very important is to make your big winners count in a really life-changing way. When you find a big winner, just let it run. And that is how, on an aggregated portfolio level, you end up making very good returns. That has been my experience in the past. So, in terms of mistakes, the biggest mistakes in absolute quantum, which I mentioned in the book as well, it was Bandhan Bank, Northeast-based microfinance dominated banking institution. And I basically failed to separate the deteriorating underlying economics of the business from the personality of the promoter at the helm. So I read a book called Bandhan, The Making of a Bank by Tamal Bandyopadhyay, and I was very impressed by Chandrasekhar Ghosh's story of perseverance and hardship. So I basically got emotionally attached to the promoter and just kept on delaying selling that stock, even though it was facing big problems in its microfinance business in Assam and West Bengal. So, basically, I should have paid attention to disconfirming evidence and negative information, but instead, I let my emotions for the person override objectivity. So that was one of the biggest investing mistakes of my career, and in terms of absolute money lost. Thankfully, beyond that, I learned from experience, and now I do not let my losses really grow very big. Now, if the stock market falls, so the small cap, mid cap index falls, and then the stocks fall, I'm absolutely okay with that. There's no problem at all. What really worries me is when the small cap, mid cap index is going down and my stock is going down. That is when a deep dive is required to understand if there is something seriously wrong with the business, because it's not normal for a small cap or mid cap to fall while the small cap, mid cap index is going up a lot. So, in those cases, do a deeper dive.
So, as if you have to advise any 19, 20-year-old in order to give a roadmap to build knowledge and wealth, right? So, how a student who's just starting his career or in the end of his academic education, how should he approach investing according to you?
I think they should start off with, first of all, reading all the classics like Phil Fisher's Common Stock and Uncommon Profits, Howard Marks, The Most Important Thing, Benjamin Graham's The Intelligent Investor. Read all of Warren Buffett's letters, both in his Buffett partnership and in his Berkshire Hathaway letters. I think they'll give you a great education and a very strong foundation in the investing world. After that, start out with some basic index funds to get started and get a feel of the market. From there on, you graduate to actively managed mutual funds. From there on, you can graduate to a EMS. And during this journey, once you feel confident enough that you can venture out and invest in stocks on your own, that is the time when you should start investing directly in stocks as well.
A stock specific question. It's absolutely fine if you're not willing to share the name of the stock. But so which stock has been proven as your biggest wealth creator till date, and what were your mindset behind selecting that stock and your journey with that particular stock?
So Rajratan Global Wire was my biggest multi-bagger till date. It was a 20-bagger at the peak. I eventually sold it when it was down a bit from the peak. It was the 16x for me. So, that is basically how you really make the really big money in the stock market. This stock was, so I purchased this stock in, early to mid 2020, and between 2018 and 19 and early part of 2020, the Indian auto industry was in a down cycle. The entire sector was out of favor, so no one was paying attention to this auto ancillary company, which had double its capacity and was also embarking on a very big capacity expansion. So as soon as the auto cycle started reviving from middle of 2020, this stock basically got the valuation got re-rated from 5x to 25x, and the earnings growth also went up. So this is how you make the truly big multi-baggers in the stock market, when you get valuation re-rating along with earnings growth. And this was a simple capex play, and this is deep value investing at its finest. You want to basically invest in such capex plays during the industry down cycle and make sure that they survive another 1 or 2 years of an industry down cycle by checking the debt on the balance sheet and the operating cash flow. That will give you a hint of whether the company is financially sound enough to survive for the next 2 years in case the downturn extends a lot. But most sectors and businesses, if not all, are cyclical. You want to buy such cyclical businesses, especially the deep cyclicals, when the industry has been completely written off and there's complete pessimism about the industry. A few leading players are also being bankrupt. So there is supply going out of the system. Buy the survivors that time, and then you patiently hold on till the cycle turns. That is how you reap maximum capital appreciation.
Wow, sir. Thank you. Thank you so much for giving the insight in terms of cyclical companies. So, those who are following you very closely, they know that आप बार बार investing journal के ऊपर बहुत focus करते हैं. That so according to you, what is the importance of investing journal, building investing journal, and how one should build it? I understand that it will take a lot of time in terms of building it, but all of our audience here are students, right? So they are like absolutely canvas over here. It's a blank canvas over here. तो आप अगर थोड़ा सा कुछ बता पाएं that what are the key points, because यहाँ पर तो people will start writing everything in the journal, right? And it'll not become the journal.
No. So basically, see, it's all about quality in all areas of life. Just focus on qualitative insights and focus on the quality and the depth of the insight. So I have a habit of noting down, any new learning almost on a daily basis in my notepad on my mobile phone, and then I simply email that to myself, and then I paste it in a neat manner into my Word document. So I've got a running investment journal, date-wise entry. It has got date-wise entries from almost every day over the last many years, and it's a very rich source of knowledge. And I've written in my book that all investors make mistakes, but the great investors repeat old mistakes less often. So an investment journal will help you revisit your past mistakes and will help you avoid making those same mistakes again. Because there are only limited number of ways in which you can go down the stock market. But but it's very important that you note them down, because when you write by hand or when you actually type things down, then you basically it brings a lot of clarity of thought to you, and it just helps you build a lot of intellectual honesty. Many times we have a big winner in the portfolio, but that stock became a big winner for some completely different reason than the original reason for which we purchased it. So this happened with Eicher Motors as well. Many people bought it for the Volvo joint venture, but Royal Enfield turned out to be a big franchise in Eicher Motors, so that helped it become a multi-baggers. But when you maintain an investment journal, it will help you remain honest to yourself and take the right lessons from your investing decisions. And there is one more great thing about maintaining a journal. It's not just your personal investing, buying, selling, holding activity. You're also storing and recording some great online content, like a great video or a great white paper or a great blog post which you've read. You're noting down your learnings from them as well. So I find this a very soothing exercise. And I think this is one of the perks of being a full-time investor that you get so much free time and you can peacefully just jot down points on a daily basis. That this is what really makes this profession very exciting, very intellectually exciting for me. Every day I'm getting to learn something new. It can be the smallest of things, but every day I get to learn something new. I mean, I wish someone publishes their investment journal into a book. I think it will be a bestseller because there will be so much great insight in that about how a value investor actually thinks and acts and behaves in reality. I think all of us should maintain an investment journal. There's so much great content in there.
Thank you, sir. So in terms of assessing a business, right? जब भी आप कोई business assess करते हैं, so how do you assess the durability of the business? Like for example, we have seen in the past, like for example, whether it is Nika or Zoom or tech stocks which gave a bull run during the COVID lockdown, they all crashed to their pre-COVID levels, and some of them are trading even below pre-COVID levels, right? So certainly there is this durability aspect of the business is missing, right? So if you just can give us the framework to assess the durability, your framework or some insights regarding that.
Sure. So first of all, let me make this one point very clear. No moat is truly permanent or durable in today's world. Who would have thought that Google, the giant of search, the epitome of search, can get disrupted by an app called ChatGPT, right? So even Google's moat got hit very badly by something called ChatGPT, generative AI, right? So if Google's moat can get disrupted or shaken, I believe no moat in the world is truly durable as such. So you do have brands like LVMH, Louis Vuitton, Hermes, Ferrari, those luxury brands which have got pricing power and strong brand equity. They're still enjoying a kind of a moat because the true test of a moat is pricing power. And pricing power comes from certain characteristics. For example, if you're providing a critical input, the value chain, which is a small overall cost of the customer, but it's a critical input, you get pricing power. So that's the moat. If you have proprietary technology, you have a moat. If you have network effect, like for example, MCX, National Stock Exchange, you have a moat. But many moats will get weakened over time. But if you can find a business which is in the process of establishing its moat, or what I call emerging moat, you can ride it till the moat is established. You can make a lot of wealth because that entire process takes many, many years. And you get valuation re-rating coupled with earnings growth, and you get multi-baggers as a result. So you try to find emerging moats if you can. For example, there's in our PMS we have a laminate, one of the leading laminate players in India, which is now fast capturing market share. And that is an example of an emerging moat where the third biggest player in the industry is basically capturing market share from the number 1 and 2. Similarly, in the sanitary ware industry, one particular player has grown 3x the industry growth rate in the last 2 years and captured a lot of market share. That's also an example of a very strong moat emerging. So market share capture the trends in market share will give it away. Actually, you'll get to know this is the easiest way to identify an emerging moat, market share capture.
Okay, thank you so much, sir. Sir, you have mentioned it in the book that investing is way of life. Actually, yeah, you cannot be a at this point of time I'm an investor and at other point of time in my life I'm not, right? So how someone can become a full-time investor? Because whenever we see any successful investor, so I have never seen any part-time investor who is successful, or at least I know a few of them. So if you can just share a few insights. I know the journey is very long. It's not that it can happen in 5-10 years. Right.
You're right. It takes broadly 10 to 15 years to achieve financial independence, and you have to, even with a job, it's possible. I achieved financial independence while working in full-time jobs in different companies, so it's possible. But you have to put in a lot of hours every day outside of work as well, and that is why you will have many sleepless nights or nights when you sleep less. But if you want to basically become free, if you want to achieve true freedom, get control over your time and get the flexibility to spend your day with whom you want, wherever you want, for as long as you want. I think you have to really work hard towards it. It will take 10-15 years, but you do have to give a lot of time and effort into this every single day, because multi-baggers won't come to you if you're just treating this like a casual hobby. So big multi-baggers will only come when you're truly immersed into equity investing as a craft, as a way of life. And value investing is far more, broader than just stocks and business fundamentals. It's a way of living a good life, a good and meaningful life, the most rational way of behaving, and basically just being a good person. Basically, it also helps you become a better person over time, because along with the wisdom which you're acquiring, our value investing community also helps each other very generously. You build a community of very like-minded people, and you basically live a very peaceful, calm, and a soothing life, basically, away from all the noise and commotion of the media, the TV media or social media, or the general public. You're basically just trying to become a bit more wiser every day, and trying to just tune out the noise as much as possible. Basically, whenever you encounter any news, just or any political news or any geopolitical news, just ask yourself, can this stand this test of time? Will this news still be relevant 5 years from now? The moment you start thinking like that, the shelf life of most news is so short that most news you'll realize is basically irrelevant. Basically, it doesn't last beyond a few months at best. So try to understand whether this news or development is it going to be relevant 5 years out or not.
Thank you so much, sir. So usually, whenever one generate an idea, right? There is this idea generation, and you have mentioned that one should always go, top down. You first, analyze the sector, the cycle, and everything, and you pick a stock, and you are still in the process of researching that stock, because this particular thing happened with me multiple times, and happened with few of students also. Like for example, the moment we हमको जो पहली बार वो स्टॉक के बारे में पता चलता है, until the time we decide that okay, let's put that stock, put the money in that particular stock. So during that period, we see the tremendous bull run at some point of time, right? So how do we or how do you remain rational when the stock price of stock, the price of the stock which you want to buy is rising every day, right? And
this is a very common phenomenon. It happens with many of us, especially in today's social media world and WhatsApp world and Telegram world, where basically information is instant. I've learned one thing for sure, that if I find a good stock, I immediately build at least a starter position in it, because there are many other smart people who are thinking in a similar way, and the stock just goes up 20-30% in just within just a week or two. So sometimes the stock just looks, it's basically taking all the important parameters. You just have to do you're still left to do some basic hygiene checks by reading the annual report and to read the footnotes in the accounts. But till the time you finish that research, at least build a starter position, because as long as the most important checklist items are getting ticked off, so basically it's like you complete 50-60% of your research very fast, but the balance 40-50% where it's being done by you, even if the stock price goes up in the meantime, at least you made some money on the starter position. So that's something which I do as well, because one thing is for sure, supply of quality businesses or businesses with growth is very limited in India. So the moment market hears from a management in the investor presentation or the conference call about a guidance of 20-30% growth for the next few years, the stock market does not wait for you to complete your research. They bid the stock up immediately within a few days. So you have to be, that's why I was referring just a short while ago, that you have to be immersed in this completely 24/7, because it will help you act with decisive speed to capture such opportunities. At least you'll get something. When you build a starter position of 2-3% in such stocks, you'll at least have the comfort, okay, that at least I was able to make some money. So that is how I would approach it.
So in terms of circle of competency, like Buffett sir has been insisting on this particular topic a lot through his letters. So how one can enhance a particular individual circle of competency.
Mentioned in the book as well in detail. Just read a lot. Basically, if you want to, for example, understand how the banking system works in India, just pick up some great books on the topic, or you start reading the annual reports, the management discussion and analysis section from the leading banks of the sector, like HDFC Bank or ICICI Bank or Axis Bank. You also go through the investor presentations, or you go through the initiating coverage reports of banks, because initiating coverage reports also contain some good industry level information. Also read the credit rating reports of these banks, because credit rating reports also contain a very good level of detail about the industry. Also, definitely great resource to learn about any industry and build your circle of competence So read the draft red herring prospectus of the leading companies, or some recent IPO from that sector, because that's one of the most informative documents on in building industry level knowledge.
Thank you so much, sir. So, which are few businesses which you always avoid, even if it comes into your circle of competency? And I'm not insisting here on the red flags which you notice, but these are the kind of business one should not get into, or one should not even.
The answer is very simple. Wherever there is intense competition, look at telecom, look at airlines. Wherever you have intense competition, and where the competition is basically fragmented, and you do not have any clear sector leader, avoid that industry, because competition acts as friction for value creation. I'll again repeat: competition creates friction for value creation. Just investing is not about the level of difficulty or giving ourselves a pat on the back by making money out of a difficult situation. Follow what Warren Buffett has taught us. He looks for 1-foot bars to step over rather than 7-foot bars which he has to jump over. Try to find the obvious winners. And even when the census was 60,000 few months ago, even then you were finding some deep value in financial stocks like microfinance companies, small finance bank. They were available below book value. Whenever you buy something below book value, it means that you're getting all the future growth for free, as long as the company is earning more than its cost of capital. So basically getting all the future growth for free. That was the level of deep value available, and those stocks have basically doubled in the last 6 months. So basically, we keep saying market बढ़ गया है, market 62,000 हो गया है. Those are people who are unable to find opportunity. Even in this market, I've already shortlisted a few opportunities, and I know beforehand what's going to happen, and I know how I'm going to make very big money from those opportunities. I'll give you a simple example here. So, few years ago, there was this company, RT Surfactants, which got demerged out of RT Industries. RT Surfactants was a micro cap. And when the institutional big shareholders from RT Industries got shares of this tiny micro cap after the demerger, they started selling it on the open market at whatever price they could, because they were not allowed to hold a micro cap in their portfolio. So the stock of RT Surfactants fell 40% after listing, and you could buy that stock for less than book value. And with all the expansion plans in place, that stock went up 600% over the next 1.5 years. This is how you develop pattern recognition. So just a few months ago, RT Pharma got demerged out of RT Industries. This was a sectoral demerger. So basically, all the big sectoral chemical sector funds, which were holding RT Industries, when they got shares of a pharma company, since they were not allowed to hold shares of a pharma company as per their investment mandate, they were forced to sell RT Pharma in the open market. Also, RT Industries was 25,000 crores market cap, whereas RT Pharma was 2,000 crores market cap. So a mid-cap fund was not allowed to hold shares of the small cap stock RT Pharma. That led to further selling. There was so much forced selling after listing of RT Pharmaceuticals that the stock was available at a P multiple of 12 times. 12. When it's a specialized API company, whereas RT Drugs from the same group is into generic APIs, inferior business that was trading at 24 times. So how can a business from one single group, a specialized business from one group, trade at 12 P, whereas a generic non-specialized business from the same group is trading at 24 P? It's non-single, right? It doesn't make any sense. So I made that stock the biggest position in my India fund. It went up 60% in just a month. So basically, when you find those no-brainer opportunities, you have to bet big, and that is how you generate an alpha for your clients.
Wow. Thank you, sir. So whenever we are reading, top investors globally, right? So I like we might face few conflicts in terms of their thought process. Just Peter Lynch, he holds, or he used to hold like thousands of stocks in his portfolio, whereas Charlie Munger sir insists on keeping it in a single digit, right? So in terms of these conflict, how how one can create his own framework out of it. Both are notable and successful investors, given a lot to the industry. So जब ऐसे कुछ conflicts आते हैं तब how you can
कोई conflict नहीं है. Peter Lynch ने basically Peter Lynch went to 1,000 stocks. Some investors hold 5-6 stocks only. Some investors hold 20-25 stocks. The key is whatever investment philosophy you have, stick to it and be disciplined. Just don't keep changing it now and then, because an investment philosophy is not something that is available next door. It is something that is carefully nurtured and cultivated over time, sometimes over a decade or more. Whatever method you choose, basically you try to stick to it during good times and bad times. For me, I follow a process of prudent diversification of 20 to 25 stocks. This allows me sufficient diversification, but and it also allows me to have decent weight in each of these stocks to generate some alpha for my PMS clients as well. So you should just stick to what suits your temperament, what suits your personality. People like Monish Papre, for example, in one or two of his funds, he has got just two stocks, making up 100% of his fund.
Yes.
Two stocks only.
Yes.
So like we do have examples of people who are comfortable with extreme concentration, and we have examples of people who are comfortable only with very high diversification. So just stick to what you believe in and what works for you. And again, here I'll also add, be it growth, be it value, be it deep value, be it special situations, or be it growth at a reasonable price, or quality at any price. Basically, whatever method you follow, just stay true to it because over a long period of time, all styles work. In the short run, investment styles are cyclical, but over the long run, value ultimately will reward you. As long as you're buying something for less than its intrinsic value, so you'll make money.
Thank you, sir. So, एक छोटा सा question I'll just clarify for the audience also. So, like, how one can be patient during, or what should be the modus operandi of an investor during the headwinds of a particular business? So, headwinds means when when the growth prospect were temporarily down for a particular business, like what we are witnessing for specialty chemical right now.
Specialty chemicals, pharmaceuticals, right?
Yes.
Correct. So basically, very simple again. We have the actual life history with us. So look at how Ramdev Agarwal held onto the stock of Hero Honda for 20 years. Look at the history of Rakesh Jhunwala, how he held this stock of Titan for 30 years. You'll get your answer basically there itself. So basically, if you look at those 20 and 30 year periods for Hero Honda and Titan, there are many blocks of 4 or 5 years in between when the stocks basically went nowhere. In fact, there are periods when the stocks fell 15% also during the journey of becoming 100 backer for each of these people. So this is why I advocate keeping a sufficiently diversified portfolio, because in a normal portfolio, 1/3 of the stocks will be declining or underperforming. 1/3 of the stocks will be giving you market returns, and 1/3 of the stocks will give you exceptional multi-bagger returns. This is how a normal portfolio looks like in real life, right? If all your stocks in your portfolio are rapidly going up at the same time, can be rest assured that in a month or two, a big bear market is around the corner. This happened with me also in late 2017. All the stocks, irrespective of market cap or quality, were going up at the same time. And then from January 2018 till March 2020, we had a huge bear market in which the small cap index fell 55%, the mid cap index crashed 45%, and thousands of listed stocks in India fell 60 to 80% during those 27 months. So, I think, just have exposure to a variety of risk factors and business models, because some businesses will face headwinds, even though they are not bad businesses, but they're just cyclical. That's the nature of most businesses in India.
So, एक चीज होती है that, how you build up your positions. Means, when you buy a particular stock and you want to put more money into that particular company or business. So, what is the exact trigger point? Because I'm pretty sure you never do, a downward averaging.
No, I don't do a downward averaging, but I do average upwards on excellent management execution. Sometimes what will happen is you buy a very high growth consumer stocks or B2C business at 40 PE multiple. In a single quarter, the net profits go up 100%. Suddenly you'll see that on a trailing basis, the P ratios come down from 50x to 40x. Now, again, and sometimes the P multiples will further keep going down with great acceleration and net profit after tax. So if the valuations come into your comfort zone because of a breakout set of earnings, that is the time when I'm happy to average up, but otherwise I don't average up. I only average up when the trailing valuation basically is sharply falling because of a breakout quarterly earnings report in which the earnings have grown by more than 100%.
Okay. And so one last technical question is that, when one should book profits, and will it be wise to keep a stop loss when a particular stock fall?
Again, similar answer like my previous question. So you can make use of a break of an important moving average, like a 50-day moving average or a 200-day moving average as your sell signal. But whatever technical, or you can also use something called a volatility stop from trading view as the you can basically modify the criteria and put your criteria there for volatility stop as your exit trigger. But again, whatever systematic self discipline you have, be disciplined to it and consistent with it. This is the see. Many times we end up using our discretion. That is when we basically get hurt. Have systematic exit rules in place. I do have mine in place, for example. And this sell rule, the systematic sell trigger, be for example, if I'm using a volatility stop in trading view for as my sell trigger, for a deep cyclical like a microfinance stock, which we hold in our PMS, I'll use a tighter volatility stop. For the structural long-term growth play like a contract manufacturer, I'll have a much more a looser stop volatility stop. So basically you tighten your moving day average or you tighten your volatility stop when you're investing in a highly cyclical business which has gone up a lot. But when the structural plays, you can make use of a longer moving average, or you can have some loose, or you can have some looser criteria on your volatility stop. So it depends again on the underlying nature of the business, your exit criteria, which you will enter in your system, how it gets triggered, which criteria will you use. That depends on the underlying nature of the business. Very, very important because many of us we experience big, a stock which has gone up 200-300%, but then it crashes down back to our cost price and we are unable to book profits, right? So I always have systematic sell, very systematic sell systems, selling rules in place for myself.
थैंक यू सो मच सर सर काफ़ी सारे स्टूडेंट्स जो यहाँ पर हैं दे आर एस्पायरिंग टू बिकम रिसर्च एनालिस्ट इन फ्यूचर right? And in our cohort we have seen a lot of research reports which were failed to highlight very basic red flags, right? And despite we won't name the houses, the research houses, but the quality of research, especially the sell side research, it's deteriorating, and it's not the case only in India, but it's like a global thing. So could you please throw some light on the research reports or the research houses you admire?
So I use research reports only and only for getting summary information on a business. I believe more in primary research, which is actually going through the actual official public filings by the company on the Bombay Stock Exchange website, the annual reports, the investor presentations, the press releases, the credit rating reports. I prefer those any day to research reports. Research reports I use only for getting a broad sense of the analyst earnings estimates and for getting summary information about what the business does and its key highlights. But apart from that, I don't really spend much time reading research reports. I like to just think for myself. The moment I let someone else think for myself by reading a research report, then that leads to a kind of a bias, which I like to avoid. So I read research reports at the very end after my complete primary research is done.
थैंक यू सर काफ़ी सभी लोग स्टूडेंट्स हैं लगभग यहाँ पर सो हाउ अ स्टूडेंट कैन बिकम अ फंड मैनेजर और अ पोर्टफोलियो मैनेजर, लाइक व्हाट इज द रोड मैप? ये बहुत कॉमन क्वेश्चन है सर.
So again, so basically, first of all, you have to get on the, you have to start off as an equity research analyst, either on the sell side or on the buy side. A sell side equity research analyst works for brokerage houses and sells those research reports to the public for their consumption. But a buy side research analyst prepares research reports for consumption by the fund manager or the portfolio manager. If you want to become a portfolio manager eventually, I think being a buy side analyst is much better because a sell side analyst is restricted to one or two sectors, but a buy side analyst is a generalist. It's a generalist which covers all sectors. And I think that's a better roadmap to become a portfolio manager, becoming a buy side analyst. But to get into a good group, into a good mutual fund or a hedge fund as a buy side analyst, it's not easy. What you can do is to basically start posting your ideas on platforms like LinkedIn or Twitter, or write some research reports and share it with a few fund managers if possible. You can also share the content in social media as well or on YouTube as well. In today's world, basically you have to try to maximize your exposure of your work to attract the eyes of your target audience. In this case, the fund house or the fund manager, and eventually they'll if you're lucky enough, they may contact you and ask to know more about you Otherwise, if you can get on your own, through a recruiter or through some other channels, all the best. But the competition for these jobs is very intense for obvious reasons, because people know that this is the roadmap eventually to becoming a successful name in the industry. So now again, you have to stand out. There's no easy answer here, but you have to really, really stand out, because information has basically become a commodity, right? So how you are able to analyze the situation and put the available information in the right context, I think that is what will help you stand out in the industry.
And so, like all of our students over here are either pursuing CFA or CFA level 3 cleared, right? So if you can just share the importance of CFA in investment industry and any advice you want to give to the junior you.
So basically, CFA is the gold standard in the finance for the getting jobs in finance in the world. But just passing the 3 levels of CFA is not that valuable. What is really valuable is if you can clear all the 3 levels and get 4 years of relevant work experience as defined by the CFA Institute. That is when you get the CFA charter, and that is when you get the right to use CFA after your name, right? So that is what you should aspire to achieve, because if you can do that, 4 years of relevant work experience as defined by the CFA Institute, and have the CFA charter eventually, that is when you get the really big paying jobs in US, UK, and other parts of the developed world. In India, even today, I believe CFA charter holders are not that well paid. Moment you get a CFA charter, you should aspire to get a very high paying job overseas if possible. Because see, you want to basically get into a very high paying job. Why? Because you want to save a lot of money, and you want to deploy all that savings into the stock market, compound it, multiply it. That is how basically how how the service class people in the field of finance become rich. Basically, you want to have very high level of savings every month. So there, this is a business in which raw material is capital, it's money. So you want to maximize the amount of money at your disposal. For that, you have to get a great high paying job. So for 4 years, even if you are working at a moderately paying job with a CFA level 3, it's okay. But try to get the CFA charter at the earliest, because that will open the doors for you in all the developed markets.
Thank you, sir. So though you have covered everything in the joys of compounding, and it's like almost a bible for modern day value investing. But if you have to pick few books or blogs for our students, what they should be.
So I'll start with the blogs first. Safalniveshak.com is a great blog for getting the basics of investing and building the right temperament. Fundu Professor by Professor Sanjay Bakshi is great for going deeper into the value investing discipline. Microcap Club by Ian Castle is another great blog for building the right mindset as a small cap, mid cap investor, and building resilience as an investor. I think that's a great blog to read. Then you also have a blog called Janav WordPress by a value investor in California called Jana. His blog is very informative. And finally, Basic Investing by Saber Capital Management is a very good blog for building your knowledge in the value investing domain. So that's for the blogs. For the books, I've already mentioned some of the great books already. They are the usual names. One Up on Wall Street by Peter Lynch, The Most Important Thing by Howard Marks, Common Stocks and Uncommon Profits by Phil Fisher. Read all the Buffett letters, partnership and Berkshire Hathaway letters. I think once you have read these, I think at least you'll have a very solid understanding and grounding in the field of investing. And then you can also finally, as a refresher, you can read Joys of Compounding. That basically, a celebration of the value investing discipline, and it celebrates, the thinking of more than 200 prominent people from history. So, that will also give you a very holistic view of how to approach value investing as a way of life.
Thank you so much, sir. Thank you so much. I understand that we have very limited time. We can have like a couple of questions from the students.
Sure.
Yes, sir. So there is this good question. Should the reports like Hindenburg affect you as value investor?
Just read the Hindenburg report itself. You'll basically do it. For example, I read all the Hindenburg report on Adani, and it was all factual data. Right? So it was all factual data. So there was nothing new in it. So it was all factual data. So you can, if you're invested in Adani stock, you take your sell or hold decision accordingly. So basically, see, the great investors in history and in today's world are active seekers of truth. Truth simply means hard data, hard evidence. That's it. Just look for hard evidence, the actual facts, and you'll make rational decisions. That's all that really is to investing. All the facts are out there. You just have to use your judgment to see whether this does this break the business model completely, or is it just a short-term hiccup in a good business? In that case, you can basically buy it at a cheap price. For example, a leading a very good well managed API company fell 50% from the peak in the last 1 year just because of short-term headwinds. But now the pricing, they're getting back the pricing power in their end product, and the next 1 year will be very good for them. So, very important to read conference calls, transcripts, and also be on top of what's happening in the industry by reading the conference call transcripts of the competitors as well. So you need to be on top of the industry trends. That is how you get an edge, information edge ahead of competition. Very few people, trust me, are willing to put in the work. Most want a shortcut, like reading a research report. If by the time the research report is published, all the public information is out there, stock is already gone down or gone up. It's too late. That's why I don't advocate reading research reports. I tell everyone that should be just as a leisurely reading activity, nothing else. But you have to put in the work. Basically, read the public filings.
Thank you, sir. So when a particular company posts a good result, so in few cases the stock makes a top, while in other cases the stock starts its upward journey. So how can a retail investor differentiate between these two?
You can only know it after the fact, right? This is where having a systematic self-discipline in place will help you get out in time. So this happened with me as well. So not a stock recommendation when we do not hold the stock in our PMS or India fund. KPIT technology. After the most recent quarterly result, the stock crashed 20%. Then people were saying that the top for KPIT technology has been weak. But then the stock went up 40% from there. Now yesterday it was 1,000 rupees. They made an all-time high. So two sets of people, one who wrote off the stock after it fell 20% after the recent quarterly earnings, saying that this story is over, the stock has stopped. Now the stock went up and crossed an all-time high yesterday. Now people are saying that was just a short-term play. So how will you know in real time whether that time it was the top or whether now is the top or just the beginning of the journey? Wow. Only a systematic self-discipline, again repeating, only a systematic self-discipline will help you exit in time in such cases.
Thank you, sir. And so one very interesting question that since the market cycles are getting shorter and shorter, right? So is the deep value investing still relevant, or one should look for momentum investing or growth at reasonable price kind of philosophies?
Right. Both deep value investing and momentum investing work exceptionally well in a shorter market cycle. Because if you buy deep value, you get rewarded much faster. And if you're playing momentum, because the market cycle is short, you again get rewarded with big gains in a short period of time. Earlier, you used to make gains over a long period of time, but now because of the short market cycle in which the rise is vertical and the fall is vertical, both in deep value investing and in momentum investing, you can make great money because of the short term market cycle in a very short span of time.
Thank you so much, sir. I think we are already overshot 1 minute. So thank you so much for taking out your precious time and sharing your wisdom with the students.
I wish all of you the very best. I think this profession is very exciting and very highly rewarding, but you have to put in the work. Try to build a good network. Try to get in touch with like-minded people, and most importantly, try to be a person of value. And try to add as much value by sharing ideas and research with your circles and with people in the community. Because this is, trust me, if you can build your goodwill over the next 5-10 years in the industry, this goodwill will carry you a long way. Because over time, you'll build such an incredible network like I've built over the last 15 years. Every single day, there's not a single day when I'm not given a great stock idea or a promising stock idea by one of my people in my network. But to build a network of such wise people, smart people, takes years. And it takes a lot of effort of adding value to them over the years. You build your reputation. Try to build your reputation, because how does Warren Buffett get the best deal in America? He has built a reputation, right? People trust him. Similarly, same thing. Do the same thing in investing as well. Build your reputation by being very generous with your help and your ideas and your knowledge. Try to help as many people as you can, because the moment your reputation gets established as a credible, honest, genuine person, our community says that right people will reach out to you and they'll try to help you.
Oh, thank you so much, sir. Thanks a lot. Thank you so much for your insights, sir. Looking forward to meet you in person someday.
So, Parth,
Thank you,
it was
sir.
a pleasure. Thank you so much
Absolute
for the
pleasure.
time, and I wish all of you
Thank
guys
you,
the
sir.
very, very best. Thank you
Thank
so
you so
much.
much. Bye bye. So thank you so much for आप लोग लास्ट तक रहे. And I believe जो रोड मैप उन्होंने शेयर किया है to be a a portfolio manager or a fund manager, that is somewhat हम लोगों का भी जो एक 3 stage model है वो बिल्कुल सेम है. चलो चलो, thank you so much for attending the session.